In this video, I'm going to tell you why buying deep in the money call options is a lot better than buying stock. We're going to go through how we're going to save over 50% and also double your returns over 100% in this example with AMD. So if you like the sound of that, all I ask for is that you smash that like button and don't forget to subscribe. So let's get right into the video. Now, buying deep in the money call options is effectively a substitution of buying stock or controlling 100 shares of stock, because we'll be doing one call option in this example. So the first step of this strategy is you want to do this on a stock you're bullish on. Now, I've just picked AMD. I am bullish on AMD, but you can do it on any stock that's been absolutely battered and you still like the fundamentals and you think over the next 12 months it's going to be an absolute banger. But in this example, let's just go with AMD. Now, what we want to do is we want to look for the 90 delta call option roughly around a year out. So if we have a look at the options chain for AMD, we can see it's currently trading at 122.20, 128.24, and I'm on June 80, 2026, which is 362 days out. And what I've done is selected the 90 delta call option, which you can see here is currently sitting at 89.71. And that is this $70 strike price. And we'll just go with the ask for now with the worst case example, is that the cost of this option is $64.10 per share. So one contract, 100 shares. It's going to cost $6,410 to buy this option. So that's what I've got here. $70 strike, June 18, 2026. The cost is $6,410. Now, when you compare that to the cost of buying 100 shares outright of AMD, you can see AMD is trading at 128.24. So per share. So if you times that by 100, that would be $12,824 to control 100 shares of AMD. Now, you can see here, what this is going to show you is that I'm only going to be spending, if you were to buy the deep in the money call option, 6,410, and that is roughly 50% less capital outlay up front to basically get the same movement of AMD over the next 365 days. So that's the first thing that you need to bear in mind here when utilizing a strategy like this. So we're going to be saving 50%. So the next step is to calculate the break even. And to do that, you simply take the call strike, which is 70, and add the call option premium, which we know is 64.10. That adds up to 134.10. So again, AMD, that is currently trading at 128.24, just needs to move, what is that, $6-7 from the current price in the next 365 days for us to break even on this trade. So it's always just good to know, where does AMD need to be for you to break even. So now the next bit is, how do we calculate the potential return on this? And let's just assume, for argument's sake, that that AMD over the next 300 odd days moves up to $200 near the date of expiration. So we know at 100 shares, if we take the 12,824, it's going to be 20. That it's going to be worth 20,000 if AMD is trading at 200. The difference between those divided by the original is a 56% return. So that's a 7,176 ROI, which again is absolutely fantastic in 360 odd days time. Now, the next one is, what about the call option? So what we need to do there is, with the call option, we go back to it here, move this across, is that we want to take the price it's currently trading at, so we know that that is $200, and we want to minus it from our current call strike, which is 70. So that's $130 and then what we want to do is 130. We want to minus the cost of the option, which was 64 and 10, which leaves us $65.90 per share, which if you times by 100 is 6,590, which is less than 100 shares, but you are paying less than 50%, but it's 103% on your initial investment of wherever it is here, 6,410 of your debit paid. So you're paying 50% less capital up front, and you're making pretty much double what you're making there. And we're not even too far away between the two numbers here, and you're spending half the money. Now, not only that this strategy is so powerful because you're going to be saving 50% and also making 50% extra, 100, 103% gains on your return on capital, assuming it gets to 200. But again, if it gets to 190, these percentages will roughly, the difference between the two will roughly be the same, is you can sell shorter dated covered calls. So for example, let's just say it's 64.10 cents. And let's say you wanted to do a covered call 27 days out. And let's say you wanted to sell, we know our break even is 134. So let's just say you wanted to sell, there's not many call options here haven't come in. Let's say you want to sell the 140. You can see here that our debit cost drops down from 64.10 to 61.77. So again, this will impact the overall ROI of the returns of everything else that you're doing. This is based under the assumption that AMD over the next 27 days doesn't go to 140. So even if it blows through the 140 strike, you still would have made money on this trade. So let's work that out. So let's just say it closed at 150, but we know we capped our profit at 140. So what was it? Yeah, 140 minus our $70, which is our cost of our call strike, which was obviously 70. Don't know, I need to work that out. So 70 minus 64.1 is 5.9, which again is $590. 590 plus the 188 credit that we're going to get from there. So that is $778 for this trade. And if AMD stays below 140, we can sell another covered call and therefore keep lowering out that cost basis and keep bringing that down and therefore keep making money. So again, I really hope you've enjoyed this video. Again, take a screenshot of this and have a go with it with a stock that you like or you're interested in. Let me know what your thoughts are. Comment down below, and I shall see you guys in the next video.